Hey everyone, and welcome to This Explainer. I am so thrilled you're tuning in today because we are diving into something absolutely fascinating. We're stepping completely off those loud, chaotic trading floors you see in the movies, and we're plunging straight into the hidden, high-speed, completely invisible world of modern stock markets. We're going to break down the massive, complex web of algorithmic trading to figure out who really holds the power. So let's just jump right in.
I want you to ask yourself a serious question right off the bat. Are you playing a rigged game in the stock market? Think about it. When you sit at your computer or pull out your phone to make a trade, are you actually competing on a level playing field? Or is the whole system stacked against you by machines that operate faster than the blink of an eye? Well, by the end of this explainer, you're going to know exactly what you're up against.
Okay, here's our fast-paced syllabus for today. First up, the algo trading revolution. Second, speed, efficiency, and risks. Third, we'll look at the dark side of algos. Fourth, regulating the machines. And finally, number 5, a transparent future. Starting off with Section 1, the algo trading revolution. Between 2010 and 2020, we didn't just see a little bit of growth in trading volume, we witnessed a relentless, complete takeover. In literally just one decade, algorithmic trading absolutely exploded as a percentage of total volume. These algorithms, they aren't just some experimental side project anymore. They are the absolute dominant force dictating exactly how international financial markets operate today. So how did we actually get here? Well, it's kind of like a giant puzzle. The seeds were planted way back in the 1970s when digital order processing first emerged. Then, moving into the 1990s, we saw the rise of much more sophisticated trading platforms. But a really pivotal moment, especially for Indian markets, hit in 2008. That's when SEBI introduced direct market access, or DMA. Talk about a total game changer. It allowed institutional investors to bypass human brokers entirely and execute trades directly on the exchanges. Basically, the speed limit was completely removed. Trades that used to take minutes of phone calls and human coordination were suddenly happening in absolute microseconds. Just computers talking directly to computers.
Moving on to Section 2, speed, efficiency, and risks.
Automating our financial systems is totally a double-edged sword. On the pro side, you get incredible power. We're talking millisecond execution, way lower transaction costs since humans aren't in the middle, and emotion-free trading that sticks strictly to the math. But on the con side, the sheer unimaginable speed of these systems means that when things go wrong, the disruptions spread like wildfire. Take the 2010 flash crash in the US. In a matter of literal minutes, high-frequency algorithms severely aggravated a market decline, and the Dow Jones plummeted nearly 1,000 points. Trillions of dollars in market value just vanished in the time it takes to brew a cup of coffee. Now, it did inexplicably rebound shortly after, but man, it was a terrifying wake-up call about how fragile automated trading can be. Which brings us to Section 3, the dark side of algos. We have to confront the ethical challenges here, specifically some of the manipulative tactics currently plaguing the system. A huge one is called spoofing. Spoofing is when an algorithm places massive, deceptive orders to create a totally false impression of market demand or supply. But here's the catch. They intentionally cancel those orders before they ever actually execute. It's basically a massive financial head fake. These fake signals mislead human participants, pushing prices in artificial directions, and ultimately it just completely erodes investor confidence. Then we have another tactic called layering. This is where multiple orders are inserted at completely different price points to artificially manipulate and exploit a stock's valuation. And the craziest part? These algorithms execute these deceptive strategies at speeds completely beyond human capability. You literally cannot click your mouse fast enough to react to a machine that's designed to trick you. And this right here is exactly why this matters to you. On one side of the ring, massive institutions have a huge advantage. They use high-frequency algorithms, they have immense resources, and they even physically place their computer servers right next to the stock exchange just to save a fraction of a millisecond in data transmission. On the other side, everyday retail investors face what's called crowding out. We are structurally outpaced. We have unequal technological access. It creates a glaringly uneven playing field where you are at a massive disadvantage, even though everything the institutions are doing is technically within legal bounds. Section 4, regulating the machines. So who's actually stepping in to fix this mess? Well, different regions are tackling it in different ways. In India and the US, regulators like SEBI and the SEC focus heavily on pre-trade risk control, real-time monitoring to catch weird behavior, and trying to mitigate those physical latency advantages. But over in Europe, their MiFID II framework takes a different route. They push for the absolute highest level of transparency and auditability. They enforce incredibly rigorous standards, demanding wide-ranging documentation even in private financial exchanges known as dark pools. Just to give you an idea of how seriously this is taken, in India, a trading member has to survive a strict, multi-step gauntlet to even get algorithmic trading approval from SEBI. You can't just boot up a laptop and start trading. First, you have to submit a formal undertaking. Second, you must hold a hefty 50 lakhs in base minimum capital. Third, you've got to pass rigorous UAT and mock software testing. And fourth, you have to physically demonstrate your automated risk management features. It is a highly demanding process designed for one reason: to keep reckless code completely out of the market. And finally, Section 5, a transparent future. Because honestly, regulation alone isn't going to cut it. We need better technology. Take, for example, an advanced AI model called a long short-term memory network, or LSTM. See, older traditional statistical models often crash when they try to analyze giant, chaotic data sets. It's a mathematical problem, where the calculations just become too massive and unstable. But an LSTM model can actually capture long-term sequential dependencies. It successfully predicts complex, long-term stock volatility. It totally proves that advanced AI can be incredibly robust, accurate, and super beneficial for risk analysis when it's built correctly. But there is a massive danger we absolutely have to avoid: the black box problem. You see, many algorithms function as black boxes, meaning they completely obscure their internal workings and decision-making criteria from everyone, both the developers and the users. If a market disruption or a crash is triggered by one of these black boxes, accountability is basically impossible. You have no way of figuring out who is responsible or what factors actually caused the crash. We urgently need a better, more transparent kind of AI. And that brings us to the solution: the 4 pillars of ethics in AI. For an algorithmic system to be truly reliable, it must be transparent, explainable, fair, and auditable. This whole framework is anchored by what we call explainable AI, or XAI for short. XAI is a game changer because it allows developers and, crucially, regulators to actually see and understand the bias, the logic, and the exact rationale behind an algorithm's split-second trade, all in a way actual humans can understand. It finally takes the lid off the black box. So let's summarize the technological cavalry coming to the rescue here. To protect the market, we really have 3 main solutions. First, that explainable AI we just talked about for real-time decision tracing. Second, blockchain ledgers, which create unalterable, permanent audit trails. And third, advanced machine learning algorithms designed specifically to instantly detect unusual patterns and anomaly manipulation before they can wreck the market. Essentially, innovation is fighting back against manipulation. Which leaves us with this final provocative question: can algorithms ever be truly fair for the everyday investor? We've seen the sheer power of high-frequency trading, the incredibly dark manipulative tactics out there, and the awesome technological innovations pushing back for transparency. The tools for an equitable market are definitely being built, but they are going to require relentless oversight. I really hope this explainer helped you understand the invisible forces shaping your investments. Thanks so much for learning with me today. Stay curious and always know the game you're playing.